joined by Kelvin Tay. Kelvin is a Chief Investment Strategist at UBS Wealth Management there. Kelvin, thanks for joining us once again. If we get a decline on the Hang Seng today, it means that we'll have 8 straight days of this. I'm going to put you on the spot and make you call this one. Are we going to break out of the torpor that we've had?
Certainly. I think a lot of it is because of the, it's coinciding, unfortunately, with the soft patch of data that we have coming in from the US economy, as well as the potential end of QE2 at the end of June. And when that happens, you're going to see a lot of liquidity actually move back to the US, potential dollar rebounding. And that has historically always been negative for the Hong Kong market, actually.
Well, I mean, the Hong Kong dollar is pegged to the US dollar, so it perhaps is a sigh of relief for people like me who earn it.
Absolutely. You might want to get your pay pegged to another currency, perhaps the Sing dollar as well, or the other Asian currencies that we're actually pretty positive on. At this moment in time, we're actually positive on the rupiah as well as the Korean won.
Yeah, just also going to look at these equity markets now. What are they pricing in? That's what people want to know. I mean, the Chinese market has been in the doldrums for a while. I mean, I think for the last year, really, to some extent. What is being priced in? What's being priced in the US, and what about Asia?
I think at this point in time, people are still thinking about whether the Chinese economy is going through a hard landing or a soft landing. And certainly the case is still being debated very actively on at this point in time. Where we are concerned, we believe that a soft landing is pretty much in the bag. And therefore, we're actually pretty positive on China. But unfortunately, the soft patch of data that's coming out from the US economy, as well as the Chinese economy at this point in time, is certainly not doing very well for sentiment. And I think the market's basically reacting on sentiment right now, and certainly not on fundamentals. If you look at fundamentals, valuations of the Chinese market is actually very, very attractive. And earnings growth numbers are there as well to actually support that. So in terms of the fundamentals, there's really nothing wrong with the Chinese equities market.
But there are certain things which are unknowns as ever, and one of them is inflation and the course of inflation looking ahead. So what are the risks?
Well, we believe that inflation in the second half of this year, where the Chinese economy is concerned, is likely to moderate. And when that happens, we believe that the current level of tightening that the Chinese government has actually embarked on might actually moderate as well. And if that's the case, then you see liquidity coming back to the Chinese equity market, and therefore positive for the Chinese economy. But certainly, make no qualms about that, about the fact that inflation, where China is concerned, has now actually is likely to be at this level for quite some time. We, in fact, believe that inflation has actually not peaked, and is likely to peak towards the end of this month. And therefore, you're going to see quite a fair bit of volatility coming in on a short-term basis.
Now, in your notes, you said you needed a diversified portfolio, but of course, isn't that always the case? I mean, you can't put your eggs into one basket. What do you mean by it, and what do you mean by a more specifically diversified portfolio too?
When we talk about diversification, we're basically talking about diversification across different asset classes. Like, for instance, we believe that inflation will be a serious structural issue from 2013, and that no one particular asset class is going to help you diversify or inflation hedge your portfolio effectively. Therefore, for that reason, you need to diversify your portfolio across different asset classes. And where inflation is concerned, we believe that commodities, equities, property are actually very, very good inflation hedge asset classes. And you should also complement your portfolios with some inflation-linked bonds as well. But again, the problem with these different asset classes is that sometimes liquidity for certain asset classes might not be the kind of liquidity that we expect with regards to the equities market. So it might be very difficult for the average man on the street to actually diversify his portfolio effectively.
Kelvin, thank you very much indeed. Kelvin Tay there from UBS, just having a look at how you should be positioned as he sees headwinds coming across this part of the world as prices go up and inflation ramps up, but seeing also a drop back there in the inflation rate towards the second half of the year in China.